Grant Cardone claims to control over $5 billion in real estate. But here's what he doesn't tell you. Almost none of that money is actually his. And the strategy that made him rich? It's not what most of his followers think they're copying. Today, we're pulling back the curtain on how Grant Cardone actually makes his money, why his real estate empire is built differently than you imagine, and most importantly, why trying to replicate his model without understanding it could destroy your financial future. This is Luxona, where millionaires are made through truth, not hype. Grant Cardone has built an impressive empire. There's no denying his business acumen, his ability to raise capital, and his skill at personal branding. But there's a dangerous gap between what Grant Cardone actually does to generate wealth and what his followers believe they should do to get rich. Most people think Grant Cardone got wealthy by buying rental properties, collecting rent checks, and slowly building a real estate portfolio. They think if they just buy enough rental units, leverage other people's money, and scale aggressively, they'll become the next Grant Cardone. They're wrong, and this misunderstanding is costing people their financial futures. Let me explain exactly how Grant Cardone makes his money and why his model is fundamentally different from what most real estate investors are trying to do. Grant Cardone is not primarily a real estate owner. He's a syndicator. Think of him as a financial middleman who brings together investors and real estate deals. When Grant says he controls $5 billion in real estate, he's talking about assets under management, not assets he personally owns. Here's how real estate syndication actually works. Grant identifies large commercial properties, typically apartment complexes worth tens or hundreds of millions of dollars. But instead of buying these properties with his own money, he raises capital from hundreds or thousands of investors. Each investor might contribute $50,000, $100,000, or several million dollars. Grant pools all this money together, adds some debt financing, and purchases the property. The investors become limited partners, while Grant's company becomes the general partner managing the deal. Now here's where Grant actually makes his money. First, he charges acquisition fees, typically 1 to 3% of the total purchase price. On a $100 million deal, that's up to $3 million in fees before the property even generates a single dollar of rental income. Second, he charges asset management fees, usually 1 to 2% of gross rental income every year. These fees come off the top, regardless of whether the investment is profitable for the limited partners. Third, and this is where the real money is made, Grant gets what's called a promote, or carried interest. This means after investors receive their preferred return, usually 6 to 8% annually, Grant gets a disproportionate share of any profits above that threshold, often 20 to 50% of all excess returns. Finally, Grant monetizes his brand through courses, coaching, books, and speaking engagements. The real estate gives him credibility, but the education business generates massive cash flow with much higher profit margins. So, when Grant Cardone talks about his real estate success, he's not making money the way most people think. He's not collecting rent checks and hoping property values go up. He's collecting fees and promoted interest from managing other people's money. This is a sophisticated business model that requires massive capital raising ability, deep real estate expertise, and significant infrastructure. It's not something you can replicate by buying a duplex and renting it out. But here's where this model gets dangerous, especially in today's economic environment. Real estate syndication is built on leverage, both financial leverage and operational leverage. Most syndications use significant debt financing, often 70 to 80% loan-to-value ratios. This amplifies returns when everything goes well, but it also amplifies losses when things go wrong. And things are going wrong for many syndicators right now. We're in a rising interest rate environment. Many syndications that were underwritten, assuming they could refinance at low rates, are now facing massive payment increases. Properties that were supposed to cash flow are bleeding money. Some syndicators are being forced to sell assets at losses or ask investors for additional capital just to keep properties afloat. There are lawsuits, there are failed deals, there are investors who put their life savings into syndications that are now worth less than what they invested, if they're worth anything at all. This isn't a criticism of Grant Cardone specifically. It's a warning about the risks inherent in highly leveraged real estate strategies that most people don't understand when they try to copy them. The average person following Grant Cardone isn't building a syndication business. They're buying small rental properties, often with maximum leverage, thinking they're following his playbook. But they're actually taking on all the risks of leveraged real estate investing without any of the fee income or diversification that makes syndication potentially profitable. When you buy a rental property with 20% down, you're not diversified across hundreds of units like a syndication. You're not collecting management fees from other investors. You're not getting promoted interest. You're just highly leveraged on a single asset, hoping it cash flows and appreciates. That's not investing. That's speculation. Let me offer you a different path, one that doesn't require you to become the next Grant Cardone or risk your financial future on highly leveraged real estate deals. The most reliable way to build wealth is actually much simpler and much less risky than what most real estate gurus teach. First, focus on increasing your income and reducing your expenses so you can invest significant amounts of money consistently. This might not sound exciting, but it's the foundation of every wealthy person's financial strategy. Second, invest that money in diversified, low-cost index funds, particularly those tracking the S&P 500. Over the past 30 years, the S&P 500 has averaged about 10% annual returns. That might not sound as exciting as Grant Cardone's promises of massive real estate returns, but it's consistent, liquid, and doesn't require you to manage tenants or worry about interest rate cycles. If you invest $2,000 per month in S&P 500 index funds and earn that historical 10% return, you'll have over $1.4 million in 20 years. Do that for 30 years, and you'll have over $4 million. That's without leverage, without debt, without tenants, and without the stress of managing real estate deals. Now, if you want to invest in real estate, there's a safer way to do it. Buy real estate with cash, not debt. This eliminates the refinancing risk, the cash flow risk, and the leverage risk that's destroying so many investors right now. Yes, buying real estate with cash means lower returns initially, but it also means much lower risk, better sleep at night, and the ability to ride out economic downturns without losing your properties. You can also invest in real estate through REITs, real estate investment trusts, which give you exposure to commercial real estate without the headaches of direct ownership. Many REITs are managed by teams with more experience and resources than individual investors could ever have. The key insight here is that Grant Cardone's success comes from being a business operator, not just a real estate investor. He's built a capital-raising machine, a property management company, and a personal brand. That's a full-time business requiring specific skills and significant capital. Most people don't want to become full-time real estate syndicators. They want passive income and wealth building. For those goals, leveraged rental properties are actually a poor choice compared to diversified stock market investing. Here's what I want you to understand. Building wealth doesn't require you to copy celebrity investors or chase the latest real estate strategy. The fundamentals of wealth building haven't changed. Earn more than you spend, invest the difference consistently, diversify your investments, and let compound interest work over time. Grant Cardone has built an impressive business, but his business model is not a personal wealth-building strategy for most people. It's a capital management business that happens to focus on real estate. If you want to build lasting wealth without the stress, complexity, and risk of highly leveraged real estate deals, focus on the basics. Increase your income, reduce your expenses, and invest consistently in diversified index funds. That might not make for exciting social media content, but it will make you wealthy over time. And isn't that the real goal? This is Luxona, where millionaires are made through truth, not hype. If this video helped clarify the difference between building a real estate business and building personal wealth, subscribe for more honest financial education. Now, I know some of you want to go deeper into the mechanics of real estate syndication, the specific fee structures, how to analyze syndication deals if you're considering investing in them, and the detailed math behind why debt-free investing often outperforms leveraged strategies over the long term. I'm going to break all of that down in much greater detail on our Patreon, including real case studies and spreadsheet analysis you won't find anywhere else. The link to our Patreon is in the description below. For those ready to move beyond surface-level financial advice and dive into the real strategies that build lasting wealth, that's where we get into the advanced material. And remember, the best investment strategy is the one you can stick with through good times and bad. The path to wealth is simple. It's just not easy, but simple and sustainable beats complex and risky every single time.